Tony. We're here to talk about the different ways in which you can invest in residential land. And there's the old way with a traditional house on top of it. And then there's what we believe to be the new way, which we're going to be unpacking today. You want to maybe get us started just to frame this conversation and just give us an understanding of what is typically understood to be residential investment property, aka the old way?
I think most people understand the old way because it's how we've looked at property for decades, if not, over the last century, where you would buy a home, you would get renters in there, and it would go up over time. You take care of your renters and you keep a consistent income, but you could always realistically expect it to be negatively geared. So it's going to cost you some money, especially with the interest rate environment we're in now. It's definitely costing investors a lot of money. So the old way was very much relying on the capital growth over time. But now with the prices where they're at from the last 5 years over COVID and different government schemes and, large amounts of migration and things like that, it's really pushed up a lot of demand, but nothing is really helping the supply. So that old way is really squeezing investors at this stage.
Understood. It does create problems, especially in a interest rate environment where holding costs are going up and living expenses are going up, but incomes typically haven't followed suit. So the margin or the amount of money that people can allocate to holding that land has been squeezed pretty dramatically.
And it also squeezes a lot of people out of the market too. Mm-hmm. It makes it not even viable to look at an investment for so many more people.
Yep.
People that otherwise, when the prices were a bit more reasonable and the interest environment was a bit more friendly, they could look at investments. But now it's just cutting more and more people out every year who are able to invest, which again is not helping the supply issue.
Yep, that makes perfect sense. Certainly when you look at it from the perspective of people building new homes as their investment property, which is kind of the best of both worlds for society. You get a good outcome for investors and you get new supply where people can live. It's not helpful at all in the broader context. And then we think there's a better way. And that better way, maybe for the sake of this conversation, can be the new way, in which people get a chance to hold that residential land, but at the same time they can generate more income than it's costing them to hold. And that allows them to tick a few boxes. You've got the real life perspective that you've described before, whereby if your existing portfolio, each property is costing you $200, $300, $400 a week to keep, and that's a moving target that changes with interest rates. You're in a certain amount of under a certain amount of pressure to hold that portfolio. It's costing you lifestyle decisions because the money that you're investing in those properties, you just don't have it for other discretionary purchases. Where if you have a property that's actually generating cash flow, it's a very different conversation. Each property is putting you in a stronger financial position from a cash flow perspective. It's making you look more attractive to lenders to keep building that portfolio. So not only is this one easier to hold, but the next one is easier to purchase. And because each property will make your position stronger, each property is actually exponentially increasing your ability to purchase more. So from a portfolio building perspective, if you look beyond that sort of one investment property, it's actually critical.
I think the reality is there too. It's looking at rewarding what's working for the economy in real time. We need supply. We need more housing. Housing's unaffordable. This new way not only is good for investors, but the only reason it is good for investors is because it's good for the tenants as well.
Yeah, it's meeting a real world.
That's right.
It's fixing a real world problem, which is awesome. So just to unpack it for people who are listening and may not be familiar with it, what we're referring to here, talking about the new way, without being too cryptic, is that it's co-living investment. And how co-living works is your dwelling's going to look from the street, it's going to look very much like the house next door. And the main difference is instead of renting it the whole house for one family or one tenant, you're going to be renting suites which have been specifically designed to accommodate a party. And you're going to have anywhere between 3 and 9 of those within the envelope or within the building. And you're going to rent each of them individually. So you're going to have 3 to 9 tenants, depending on the configuration of the house, which will multiply your rental income significantly. So in terms of yield, you might end up making 3 to 4 times what the house next door would generate in the same location. And you also have a number of benefits that are going to come from that. So if you look at the vacancy risk, for instance, if you have one tenant and you lose that tenant, there's no income coming from that house. And again, that can create some serious pressure on your cash flow. If you have 9 tenants and someone moves out, typically what you will find is that for a period of time, you will find yourself with 8/9 of your rental income, which is still far in excess of the cost of holding the property. Even if you lost 2 tenants at the same time, highly unlikely, but possible, you would still be in positive territory, probably still so with 3 tenants.
And that's a huge advantage. People are always talking about diversifying their income streams. You know, this is an investment that has inbuilt a diversified income stream.
Yep.
Which is exactly what you're referring to.
So that's a very powerful tool in mitigating that sort of vacancy risk, where any vacancy is going to be a lot less painful than if you were to lose your one tenant for your one dwelling. So you have that higher income, which is really important. It's going to be in excess typically of the cost of holding that property. So it will create cash flow in your everyday life, which you can use, to pay off your existing mortgage on your house, to supplement your lifestyle, to do as you please, really. But what that cash will also do, and I touched on that before, but I can't stress how critical that is and how underestimated that is, it will boost your borrowing capacity. Now, real financial freedom, real success out of property investment very rarely comes out of a portfolio of one property. As a matter of fact, it very, very rarely comes out of a portfolio of 2 properties. You need to be able to build large portfolios to multiply the benefits. And in order to do that, you need the cash flow, both in real life and from a borrowing perspective. And that's what's going to happen.
And the cash flow helps you sustain that portfolio and grow it. Then you're getting the capital growth naturally from all of those properties over the years.
Because those properties, and that's what differentiates these versus, say, commercial property investing, is that these properties sit on top very valuable residential land that you would select almost with the same wish list than you would if you were doing that capital growth play. So you should have those co-living properties in locations that have absolutely all the boxes ticked for that future capital growth. So you can get that yield and you can get that income without compromising on your future prospect for capital growth. But you can then multiply that across multiple properties, and thus more diversity, less risk, better cash flow. It's really quite remarkable in the way it works. And one of the main differences structurally from the house next door is that your co-living property will be built to a 1B certification standard, which is somewhere in between the 1A, which is 99% of the residential dwellings you would find in Australia, and that category 3, which would be your commercial buildings, apartments, and the likes. That 1B certification is crucial. It's going to create a little bit of friction on the way in. It's going to cost a little bit more to build. It's going to have a few more conversations with the council to get approved. But it also future-proof your co-living investment property, because then you're well and truly within the regulatory frame and you're protected from any future sort of fluidity in the regulatory environment because you've got that 1B certification.
And that's what really differentiates this from a traditional share house. A traditional share house is just a regular house where there might be a few people sharing the bills and sharing the rent, but it's not a purpose-built 1B certified dwelling. So it legally can't even be a share house or a co-living property.
Which is an issue that most people are unaware of. In some states, that's even a criminal offence.
Yeah, and there's jail time associated with some of those penalties.
Which is really intense. But you have that differentiation. The other thing I think that really makes a huge difference is that purpose-built model where you really cater for that sharing scenario and people being able to retire in their own space with an ensuite, a kitchenette, potentially a courtyard that belongs to them. So that purpose-built, that purpose design that is used for co-living properties is going to extract a much higher rent per room than you would get when you're sharing a traditional property and people have to share a bathroom and there's conflict in the kitchen about this and about that. pun intended, but the harmony within those homes is much, much higher than within a shared home. The comfort, the safety is much higher than in a shared home.
And you don't have to rely on other people either.
That's right.
You don't have to rely on other people to pay their fair share or do their fair amount of cleaning. You've got a centralized property manager who's specialized in managing that type of property, and they're on call 24/7, all the ones that we use. And yeah, there's no ifs or buts. It's just house rules.
Yeah, very, very, very good point. People are here in that house with individual lease. They're responsible for their individual space, and not at the mercy of anything or any misbehavior from anybody else living in the house. That's an excellent point. So that's the old way. That's the new way. I think when you put them side by side objectively, I'd struggle to see what point could be made that would drive people to the old way. Once you sort of unpack the two and you put them side by side and you look at the pros and the cons and the risks and the returns and sort of what they enable you to do and even the outcomes, I think it would be hard to challenge the concept that the new way is the way. And that's certainly where we are.
To put it into perspective with the numbers, it's really, if you're looking at spending, say, $1.5 million on an investment property, you can imagine what level of rent you would get in a regular $1.5 million property.
Yeah, you might get 3%, $45,000.
If you're lucky.
Gross. That would be your gross income if you're doing well around Brisbane, Sydney, Perth, like that.
Whereas the projects that we're doing and a few projects we're currently putting on the ground for a few clients, and some we've already got on the ground, 1.5 gets you an income stream of about 185,000, where we're over that 10% yield. And it's because, it's not the easiest thing to do, but if you do it properly, you follow the right steps. And again, for us, we probably take it a little bit further and we build to a slightly higher specification than anybody else in the space. But we attract that good tenant. We attract that sort of high quality tenant that we want to keep in there for a long period of time. And that's why we've had projects that have been on the ground for 2 years and maintain full occupancy, providing all of that income where, again, putting the numbers against each other, you can see, one's hoping for the capital growth to come one day, and it most likely will.
Yeah.
But it's going to cost you in cash flow for a long while before that.
Look, I'll just finish this segment on a point that is very topical. And for people who are listening to us in the future, just to be clear, interest rates were increased yesterday. So it's very fresh and that's very topical as of today. But I think one thing that also needs to be said is that when you have that traditional model and you're already stretched to the limit because the rates are already significantly higher than when you committed to the whole endeavor, and you're in a sort of really tense situation, and then rates go up again, and there's a lot of talk now for rents to go up another 2 times before the end of the financial year, you might find yourself in a situation where you have to dispose of the asset or when you have to make a decision under pressure. It's not your choice, you have to, which typically leads to very poor outcomes, whatever your strategy was. If you're distressed and you have to sell, it's likely that someone's going to take advantage of that. So when we're talking about that excess cash flow, which is really great when that's what happens, it becomes even more crucial when this becomes your buffer that allows you to absorb the pressure, which is cyclical. Like, the rate cycle will readjust. But if you don't have that buffer, if you don't have that ability to absorb the pain during those difficult times, then you are forced to make a decision, and you're doing so in a vulnerable condition, which is likely to lead to a poor outcome. If you've got that excess cash flow, and that excess cash flow goes from $300 a week to $200 a week, well, it's not fun. You'd rather have the money in your pocket, Fed income. But at the same time, it acts as a protection, which is basically saving you from having to sell or having to rearrange your portfolio under duress, which is really a bad sort of way to go about it. So it's a safety mechanism. It can turn from enhancing your lifestyle to saving you a tremendous amount of money because you're not forced to act and you're not forced to sell.
It really allows you to get through those high interest periods where, they don't always last forever, and, it might stay the same for a few years, but a good example is one of our current clients, they were interested in the cash flow effect that would happen with a few more interest rate rises. So we put it all into the cash flow analysis and we went through it. And I could show very clearly, even if there was 8 interest rate rises like there was yesterday, they would still be heavily cash flow positive.
Wow. Yeah.
When you get to a certain point of yield, it takes quite a lot for the interest to start affecting your return.
That's a wonderful stress test. And
Yeah.
That's a great example. Thank you.
Yeah.
Now, Tony, the new way, it's in the name, it's new, and a lot of people are not familiar with some of the specific aspects of co-living investment. And while, as we discussed, it's great, and the principle is fairly easy to understand, the implementation of a successful co-living property does require careful attention to details and avoiding some mistakes, which are fairly standard for a lot of newcomers to the space. If we have people listening now and they might not eventually seek the help of an advisor or a professional to help them through this, are there sort of a couple of key items you would recommend that they keep an eye out for, or typical mistakes that you see happening that are sort of penalizing people who are trying to enter this space?
Yeah, I would say one of the common mistakes is people trying to cut down the price by trying to find land as cheap as possible, and thinking if they put a co-living on there, it'll work just the same way.
Yeah, build and they will come.
That's right. Yeah, but they're not realizing that the land is cheap for a reason, and it's because it might not be an attractive place to live, or it lacks the infrastructure that draws people to live in a location, where that might be transport infrastructure, connecting to the public transport grid and getting into the CBD or whatever it might be. So what then happens is they're spending too much on a build, where they're spending maybe 5, 6, 850,000 on a build on a piece of land that's worth only 200,000. Everybody knows that the growth comes from the land. So you don't want to overcapitalize in the way where you're spending so much on your build and you're leaving behind a thing that's going to be giving you the capital growth over time. So I would say a lot of people out there are trying to get the cheapest cost possible to get one on the ground. And I get offered these type of projects all the time, saying, "Oh, I've got this great land and this builder that," and I say, politely decline.
You John West them.
Yeah. It's just no.
Yeah.
And we say no to so much, and we do our own analysis and we find our own locations, because when people try to cut corners like that, it ends up costing them in the long run.
Yeah.
You're cutting a corner to take your purchase price down, and you think you're still going to get the income.
Yeah.
But the reasons you're getting that lower purchase price are going to reflect in the tenancy demand and the amount you can get for tenancy. So a lot of people will shoot themselves in the foot going after those cheaper style properties where might be location. And a big problem is people building to a very basic spec.
Yeah.
And then you end up walking into something that it almost looks institutional because it's not built very well.
Yes.
They've left every luxury out, where we look at it in a much different way. So we go a bit higher spec than the average property. So, some of these properties look, better than my own home. Some of the bathrooms are beautiful, like the kitchenettes, everything, everything goes into that tenant demand, where you try to cut corners in that. And it might look good on paper, but you're going to get nowhere near, the amount of rent per room that you could otherwise get by making that extra investment right at the start.
Yep.
And when you're talking about a good income over a 10, 20-year period, it makes a very big difference to the overall investment. Just do it right at the start. So I'd say one of the first common mistakes is trying to do it cheap. And I think that's a problem across a lot of investments, but I see it quite commonly in the co-living space. I'd say another one, and this is something that can be fixed a little bit easier, using the wrong property manager. Now, if you've got a half-decent property in a good location and, some upgrades can be made to bring it up to the spec that, say, we would be happy with, and I'm talking about somebody who's made a mistake and built the wrong thing, but then you can fix those issues, and it's not as hard as going into the complete wrong location. But when you're working with an agent that's not entirely specialized in co-living, they don't have the processes or the know-how to deal with all of the issues that come along with it. And there are a lot of extra issues that come along with it. And that's why we use companies that have been specialized in only co-living style management for 10 to 15 years.
Yep.
So those companies where they might charge a little bit more, and that might, take people to go talk to regular real estate agents and get their feedback. This can also be a problem when assessing investments, because if you're talking to a regular real estate agent about a co-living property, they really don't know what to tell you. So most likely they'd say, oh, don't do that, it's too complicated, or you'll have a lot of issues with tenants, because they don't want to manage it.
Yep.
They want you to buy something that maybe they've got listed. Where you go to a property manager who's experienced in this space, they understand it. They can give you an honest overview of what they think. They can give you a full appraisal and their thoughts, and show you the data that drove them to those figures.
Mm-hmm.
And then it gives you the most honest look at the investment. Now, when it comes to the ongoing management, keeping your tenants happy in the property is one thing, but also having a property manager that has the processes in place to keep full tenancy in that property is very important. And one easy example to show that is, we've got one of the companies that we work with that when they've got one or two properties in a region that they're managing, they will actually keep an advert up for a fully furnished room that's up for rent, and they'll continuously collect a list of people that are interested to apply. So as soon as somebody gives notice that they're leaving, say, all right, well, I'm moving out in 6 weeks, or at the end of this 8 weeks, I'm going to be leaving. They'll blast out that list and they'll say, hey, this is coming up available. Apply now if you're interested. So they've got this great process where this one person's moving out, the cleaners come in that day or the next day,
yeah.
and the following day, the new tenant moves straight in.
Have you just made the secret sauce public here?
Maybe, but I won't mention who they are. But that's the sort of processes and know-how you want behind you with the property manager you're working with.
Understood.
If they don't know co-living, don't talk to them about co-living. Simple as that.
That's a very valid point. Before you move on to the next risk or the next pitfall that must be avoided, just on the topic of the property management and the professional property management and the previous comments you made about sort of the high quality nature of the properties that are being delivered, just for people again who are just exploring this for the first time and they may not have the benchmarks in their mind the same way we do, and some people who have been researching this for longer might. For the sake of the new person to this conversation, what would typically be the range of rental that can be collected from a suite within a co-living property? I understand it will vary from location to location and specifications and socio-demographics and such, but is there a range that people can reasonably sort of use when they're sort of looking at those opportunities? What have you seen materializing real life for clients in front of you?
Well, like you said, there's a lot of variables, obviously. So depending on the location, specification, all of that. But I would say a realistic range is anywhere from 380 all the way up to 550 per room.
Right.
So there was a property that we reviewed. And again, I was actually speaking to someone about this specific property I'm thinking about just this morning. And I was talking about the specification and where we're putting the next ones and all of that. And I won't mention the location, but they said, how are you getting over $400 per room? Well, there's houses for X amount and this and that. And I said, it's a combination of a lot of things, but, we build to a high specification and we've got a great process. But in areas where people are struggling to get $250 or $200 for a room, we can realistically get over $400.
Yeah.
And that's been tried and tested and proven.
Yeah, that's a lot of price elasticity where people will pay you more if you give them a better product. Essentially, that's what you're saying.
That's right.
If you provide them with something that's top notch.
And it really comes back to the numbers of the people that we're targeting for these properties. Now, one interesting statistic is 40% of people in a lot of areas in metro and capital cities are living alone. And of that 40%, there's 50% of those said that they would consider this as a living arrangement if it was, high quality enough. And a lot of the stuff that's been going on the ground that we've seen over the years hasn't been high enough quality for those people to consider. Now, to put that into perspective, if we pinpoint sort of one suburb where there might be, say, 50,000 people in that suburb, and 40% of those are living alone. So you've got
20,000 people there that are living alone.
And 10,000 would consider
wow.
living in a co-living arrangement if it was high quality enough. So then you've got, say, we usually do 9-bed in those situations, but say round it off to 10. So to build to 10,000.
Yeah, gotcha.
We have to put 1,000 of these on the ground in one suburb. So there is a massive opportunity, and there's all these people that would consider it and are waiting for something, but there's nothing out there that's compelling enough for them. Yeah. And that's why we've got waiting lists. And, for the properties that we put on the ground, for example, we had one property where he decided to move out. Within a week, he realized he shouldn't have moved out.
Yeah.
He called back, but his room was already taken, and he joined a waiting list for another property.
Yeah.
We're really building towards that demand in those established locations.
Yeah, I anecdotal, but I recently had a conversation with a gentleman who was interested in this concept, and his take was to reinforce the point that people are very willing to entertain. Is he wanted to be one of the tenant for the house, if you like, not a tenant obviously, but he was going to live in the house in one of the suites. Mm-hmm. And then lease out the remaining 5 bedrooms to third parties. So he was very comfortable to use that as owner-occupier property.
Yeah.
Taking
and
one
what
of
a
the
strategy
suites.
that would be.
I know. And I was just like, wow, that's actually really powerful. And anyway, sorry, I interrupted you, Tony. So just please tell us more about the risks and dangers and pitfalls.
I think another thing to consider is when we say tenants, in a 1B certified dwelling, the technical term is actually residents of the property. Now, there's a big difference between tenants and residents. From a landlord's perspective, there's a lot of people that are worried about the power that they have over the property themselves as the owner, because there's lots of laws that and a lot of laws that are in place for a good reason to protect the tenants. But when it's residents and when you set up your property, a big mistake that a lot of people make is not setting up, and this comes down to using the right property manager. And again, this might be a little bit more sort of secret sauce, but
we've already opened the jar, so you may as well keep pouring.
It's if you set your own house rules, which you're allowed to do, you can exit people from the property based on the rules that you've set. So if you set your own house rules, you can actually exit them based on your own rules. Now, you can't do that in a traditional investment property with your tenants, but you can do that in a 1B certified dwelling on your residence.
That's huge.
It's huge. And if you don't set those house rules, which is a common mistake, then your base is the base legislation, which is always very weighted for a good reason towards protecting the tenants and residents. But again, the residents have to agree to those house rules as well. So it's not like you can impose whatever you want. It's all with agreement when that they come into the property.